Last quarter, 8 regional banks reported losses or reserve spikes on their commercial real estate books. 3 of them ran the same playbook way back when: IndyMac, Washington Mutual, and Wachovia. They did this back in early 2007. Now, there's a lag when people get this information to when it starts to turn into a panic. There was a lag from when Bear Stearns collapsed to when Lehman Brothers collapsed. And that time frame was almost 15 months. Now, here's the reserve math bank by bank and where it can land next. All right? Let's dive into this and figure out if we've got another banking crash on our hands. Now, back on May 28th, the FDIC published its quarterly health check, and every bank in the country had to deal with this. And one number that really nobody read and really paid attention to is something I believe that's really important. In a single quarter, the banking industry set aside $21.4 billion against loans that they actually expect to go bad. So they set money aside going, hey, we have a feeling this many loans are going to collapse. So let's set aside money to make sure we don't collapse. Now, that cushion between those banks and those actual losses, the reserve coverage ratio, quietly thinned to 166.8%. So let me tell you what that dry sentence can actually do to a person. Now, picture a man who spent 31 years building a small contracting business, poured concrete in the heat, made payroll in the lean years, never missed it, not once. That man sells that business, and after the taxes and the lawyers, there's a little over $400,000 left. The entire weight of a working life that he parks that money in his regional bank. He puts it in deposit to make interest for his retirement, right? Because the branch manager knows his name and he feels really safe. He's going to use that money to retire. Now think about it. On one day then, on a Friday, let's say, the bank is seized, and he learns about this standing in a parking lot that government insurance only covers the first $250,000 of what he had in there because of the FDIC rules. The rest, more than $150,000 of his life's labor, does not have a line of people. It's gone. And that's how it can affect the average person, right? He did not gamble it. He did not buy crypto. He put his money in a bank. The retirement he spent 3 decades earning is gone. And in his 60s, he's hunting for work again. And the warning that is what is coming was printed in a government report 16 months ago in a language nobody translated for him. And he's now standing in a parking lot because the point is to keep you out of it, right? He's standing there going, what just happened with my money? And I think this is really important as we talk about right now what is happening in American banks, how the Fed has changed some rules, and how this is going to affect you like what happened in 2008, possibly. All right. Now, first off, this is general information, right? This is not financial advice, and I'm not your advisor. But the truth is, 8 regional banks drove most of that industry reserve build. We're talking about a handful of banks called Western Alliance, Bank of the UK, Flagstar, Valley National, M&T, KeyCorp, Webster, and Axios. The reason that they are bracing, these are the banks that have set aside this money expecting a certain percentage of their loans to fail, okay? And the reason why they're bracing is the fuse, the commercial real estate crash, the office towers and apartment complexes that these banks lent money against. Offices in major cities are sitting really in bad positions. They're empty with no clean recovery in sight. The share of the office loans on their payments hit an all-time record of 12.34% back in this January of 2026. That's the highest since tracking began way back dating back to the year 2000. And the country is carrying close to it's some insane amount, like $5 trillion in commercial property debt, with banks holding on to about a third of that. Much of it is now coming due at far higher interest rates than when those loans were written. Now, here is the consequence downstream that you need to realize. A loan that cannot be refinanced gets liquidated, and the regional banks eat that money that at first because they are the ones that leaned into commercial real estate during the boom, while the giant national banks pretty much sat it out. So we're talking the difference between regional banks versus large national banks. See, these regional banks are far more exposed dollar for dollar than the big names that you think of, like JP Morgan, Citibank, Wells Fargo, stuff like that, right? Now, the other side of this is the calm voices that have a real case, right? The FDIC itself called asset quality generally favorable last quarter. The industry just posted a record net income more than $80 billion that came in 3 months, right? The list of problem banks actually shrank to 54 in the nation. This is a perfectly normal number. And the only one bank failure that occurred last quarter, I believe was it Banco DK? If my memory serves me right, but only one failed, right? 1 of 8 just posted. Oh no, sorry, I go back. Banco DK is 1 of 8 that just posted near record annual profit. So a reasonable person would say, this isn't that big of a deal, right? The system is strong, and on the health of the system today, they may well be right. The trouble that is building is showing that the reserves that these banks are building up for these failed loans that they're expecting to start hitting in the near future, that's what we're looking at. It is what a careful bank looks at right before the storm, and it sees that storm coming, so they're setting things aside. There's another issue, and actually I'll bring it out now, is that banks are chasing loans. They're trying to make loans. They're trying to make this a real deal right now. And they're giving some crazy loans out. And so I built that course, the mortgage, the creative finance mortgage course. Links down below if you want that. Because we're in a time where banks are trying to get more depositors. They're trying to lend money in different ways to get more loans going, just to keep things afloat. And that's why I think it's really important that people wake up to what's happening with, Travis Hill, the head of the FDIC now, that has made it extremely easy for a bank to be liquidated on a Friday. And on Monday, it's not under the new name. It's already been there by Friday at 6 p.m. Like, they're streamlining this process. They're getting ready right now for an absolute collapse. And when I say a collapse, I'm talking about just enough of a shockwave to create a shockwave in the stock market. All right. Now, let's talk about what's going on with these banks and the big move that might be happening. And I guess it's this reserve build that we're starting to see, like money being set aside for these failing loans that aren't failing yet, but the banks are expecting it to, right? The banks that are setting aside this money against the bad loans became the most expensive bank failure in history. I'm trying to figure out a way of explaining this to people without panicking them, because this isn't a panic moment. It's one of those moments where you're seeing the bank set the money aside for future losses. So they're not going to get in trouble. But the fact is, there's future losses coming that they believe is coming enough to where they're setting the money aside. This is just one of those moments where you need to realize that it's happening. Does that make sense? This happened a long time back, or during the 2008 crisis, where we had literally the most expensive FDIC failure in history, where it cost the insurance industry around $12 billion. That's when Washington Mutual went, right? That was the largest bank failure in American history. It didn't come out until late 2007, and it was setting aside roughly twice as much for loan losses as it was actually losing. You see what I'm saying? So by the time Washington Mutual got to that, they were literally setting aside so much money, yet they still collapsed. That's why I think it's important to realize that. You see, They knew that they had made a bunch of bad loans, and they were saving and trying to build their way out of it, and as far as savings, and ultimately they couldn't do it. What's even crazier to me is there are still people with Washington Mutual mortgages right now that are priced at like 7 and 8%, and they haven't even thought to refinance those any time in the last 15 years. This is how I believe there are so many people in the general population, the public, like what you see in this photo right here during the crash of 29 and the subsequent Great Depression, where people just were sort of blindsided to what's going on in the market until it's too late. And then they're racing to their local bank to try and pull money out. And I think that is where we need to really wake up ahead of time. Banks are already starting, 8 of them, regional banks, large regional banks are putting money aside. And I'm having a hard time explaining this because I don't want people to panic and telling you that banks are collapsing tomorrow. But when you see that, just like Washington Mutual was doing back in 2006 and 2007, they failed. We're seeing that now with 8 regional large banks. They're putting money aside for future loan losses. I think we need to wake up and deal with our finances different. Sorry for the confusion, but I'm just really wanting to wake people up. With that being said, thank you so much for watching. The Economic Ninja is out.